We just went through all the main sections of both the balance sheet and the profit and loss or income statement. So how do you know when it's time to record a sale? If you're a photographer and take a deposit for a wedding that doesn't happen until next year, why should you have to pay tax on it now? If you know you'll pay for that big expense just after year end, but want to take the expense in the current year before you actually pay for it because you want to get that tax deduction, can you? These answers all have to do with an important distinction related to how you present your financials, which translates into when you pay tax on income and which expenses get applied against that income. And that distinction is whether you're presenting your financials on an accrual basis or a cash basis. We're going to talk about the cash basis or method of accounting here. So the textbook definition under the cash basis of accounting is that revenues are recognized when cash is received and expenses are recognized when they're paid. The definition you need to know is that cash basis accounting is a much easier method of accounting when it comes to the simplicity of your books. You pay tax on income when it is received into your bank account, and you get credit for expenses when they're paid out of your bank account. The key is to understand how your financials are presented and know that you pay tax on income when you receive it, not necessarily when it's earned or when the work is being performed. So where are they in your financials? Cash basis accounting doesn't show up anywhere in your financials. Rather, it determines how the financials are presented. So if you look at a balance sheet and you see accounts receivable, which is an asset account that represents money owed to you, and accounts payable, which is a liability account representing what you owe to others, you better hope you're looking at an accrual basis financial statement, because if they're cash basis, you should not see either of those two accounts on your balance sheet. So let's talk about some examples of reporting revenue using the cash basis of accounting. So it's December 2021 and I'm a photographer. I collect 1/2 of the payment, which is $3,000, for a wedding 3 months from now in March 2022. When the money is paid to me in December 2021, that's $3,000 of income that I'll pay tax on in 2021. When the wedding happens in March 2022 and I receive the balance of $3,000, I'll record that additional $3,000 of income in March 2022, and I'll pay tax on that income when I file my 2022 taxes. I'm an accountant who performs advisory services for large corporate clients. In November 2021, I spent 100 hours on a single client and billed them $12,000 for my services. Now they have 60-day terms with me and will probably take every single day to pay, so I likely won't see payment from them until January 2022. And that is when I'll record my $12,000 of income, when I actually receive the payment from them. Some examples of reporting expenses under the cash basis of accounting. It's December 2021. I'm the same photographer from up above. My studio rent is $850 per month, and I have to pay utilities every month based on the usage from the prior month. So I know that my rent is $850 a month, so I pay them on auto draft in December 2021, and that's when I get credit for that expense. However, the $62 in utilities that I owed them for usage in January 2021 wasn't paid until February 2022. If I report my financials and pay taxes on a cash basis, I get credit for that $62 of expense when I pay it in February 2022.